Está habiendo muchas dudas con respecto a lo que pueden hacer los mercados, la bolsa en 2026, los riesgos y si hay o no burbuja en la inteligencia artificial. Hemos venido a Nueva York al terreno para preguntar a los principales expertos de cómo está la situación. Hemos tenido la ocasión de entrevistar al responsable de bolsa de WisdomTree, una de las mayores gestoras de fondos del mundo, para que nos dé las respuestas. ¿En qué punto estamos exactamente? Todo eso es lo que vamos a ver ahora.
So we are here with Jeremy Schwartz. Nice to meet you in person, and we are so pleased to talk about the stock markets, the real economy here in the United States. So thank you very much for to talk with me.
Thanks for coming to the office.
Yeah, thank you for hosting me.
Yeah, great.
Yeah. So first question that I want to ask you is, many investors are worried we are in the early stages of an equity bubble. Some kind of analysts say that. Mainly in the US large cap technology companies. From WisdomTree's perspective, what signals do you monitor to distinguish between justified optimism and true excess?
Yeah, this question comes to us a lot. You know, that's the number one story. AI is driving the markets. And at WisdomTree, you know, our relationship, I've been working with Professor Jeremy Siegel from the Wharton School for the last 25 years. And when I met him, I was an undergrad student at Wharton, and he called the tech bubble in March of 2000. He had an op-ed in the Wall Street Journal, big cap tech stocks are a sucker's bet, March 14th of 2000. And so we get that question a lot, like, does this rhyme with 2000? Now, when Siegel wrote that op-ed back then, he listed 9 stocks, triple-digit PEs. These are some of the largest stocks in the S&P 500, and said you could never justify those valuations. Now, there was 9 stocks, triple-digit PEs. You go to the Mag 7 today, which is the tech leaders of today, and you say, well, does the Mag 7 look anything like tech in 2000? And as a whole, the Mag 7 is priced at around 30 times earnings. There's one stock with a triple-digit PE. The one stock is Tesla, okay? So Tesla is the only one relying on a far different, very optimistic future, but it is doing this transformational technology. It's not about the car. It's, you know, the car companies sell at single-digit PEs around the world. It is a play on AI, it's a play on robotics, self-driving, all sorts of these transformational things that people don't really know how to price. And people are betting on Elon changing the world. So that's the one stock that is very hard to say the current valuation supported, but it's betting on an optimistic future. The others at 30 times earnings, I mean, some of them I would say are value stocks actually. Like when I look at Meta and the valuation of Meta in the low 20s, and as one of the key AI beneficiaries, I'd call it value. You know, but 30 as a whole, you understand it's not like tech in 2000 where you say there's no way you can justify, you know, elevated based on some of the past numbers, but 30 is warranted based on what you see. Yes, they have execution risk. Yes, there's a lot in some of those numbers, but it's understandable. Now, you don't also have to be in the Mag 7. There's a lot of value strategies that we have at WisdomTree that could be 12 to 13 times earnings. Like the smaller companies in the US, value stocks, very, very reasonably priced. So it's some of the big tech stocks are high, but warranted. And you know, so we say no, it's not an AI bubble, and it's sort of deserving based on what you see.
So AI has driven much of the market returns lately. Do you see AI more as a concentrated risk due to narrow market leadership or as a broad multi-decade investment opportunity?
Well, for sure, a decade opportunity. I mean, I do think this is a long-lasting, early innings phase of how do companies use it, okay? So now there's a lot of infrastructure built out. I think there's going to be ebbs and flows of what stocks benefit from AI, right? So right now it's concentrated in the infrastructure. We need all these AI models, so we need NVIDIA chips, and NVIDIA is seen as one of the key leaders. Now, Alphabet, okay, Google was counted out. It was like left for dead at the beginning of the year, and it was saying they're so far behind, the Gemini models aren't keeping up with OpenAI. Well, how much 3 months makes a difference? Now Gemini is the leading AI model. The stock has basically doubled in a short period of time. It's gone from a value stock earlier this year, as we were calling it, underaccounted for AI, to now, 30 PE, reasonable, but they're being hallmarked as the best AI model. So I think it will ebb and flow. I think you haven't seen the users of AI get any credit. Okay, so we've been saying you get this broader participation, small caps. Can you start using it to be more efficient? Can you grow your revenue without hiring people? Will you have margin expansion? That is the case for the next decade, as you're saying. It's like users of the tech to do things more efficiently. There'll be winners and losers. You'll be left behind. It's sort of existential, I think, to use it efficiently. But that's going to be the next part of the trade over the next decade.
So next question that I want to ask you is, WisdomTree is known for factor-based and thematic approaches. So which structural themes do you believe are still underappreciated by the market and could offer strong long-term returns?
So you mentioned the factor approach and value. So I mentioned there's some parts of the market are 12 to 13 times earnings. So our US value fund, WTV, is the example of that. It just rebalanced the portfolio in the last few weeks. So when you look at the holdings, it's refreshed. And that has like a dividend yield around 270, which is more than double the S&P's dividend yield. But very critically, it's got a net buyback. Companies buying back shares, reducing shares outstanding, on average by 4%. So the combined is a 7% dividend buyback yield when the S&P is like 3. Okay, so this is or even less, 2.5, maybe 3.5 for a value index. We're more than double a traditional value approach with that. So that is, I think, one of our favorite stories for people worried about valuations, and that AI story, WTV, is an expression of that. I think, it's been a time in the last 15 years where the only game in town has been US tech. So US leadership far outweighs. Nobody wants international for the last 15 years. It's something like from 2010 on, the US beat international by 573%. Okay, that's a big number.
Yeah.
So I think there's a case for international, and that case for international is you said it's thematics. Like one of our blockbuster launches at WisdomTree, in my 20 years I've been here, I've maybe once seen something like this, but our most successful new launch in Europe, our European business, launched a European defense fund. That fund raised almost $4 billion this year. I think beyond just investing in defense, I think Asian defense is a top idea right now. When you look at the sort of geopolitical conflicts around the world, we launched in the US an Asian defense fund, WDAF. I think that's one of our top ideas for some of the conflicts that we see happening around the world. But more broadly, if you abstract from just the defense sector, we call it a defense tech super cycle. So the next decade, sort of like AI, is when you look at the history of innovation, like when did you get the internet? Okay, how do you trace the roots of the internet? Well, we had what's called the Sputnik moment in 1957. We wake up that Russia's launching to the moon. And now we say we need to create our own, can't be surprised, we create ARPA. ARPA becomes DARPA. DARPA becomes the ground roads to the internet. Okay, when you have your cell phone, it came from spending in World War II for walkie-talkies that led to the cell phone. So what you say is all the spending on defense is going to lead to a lot of interesting innovation. And so, again, the US has been the only game in town with tech. You're now seeing it in Europe. You're seeing it in Asia. And so don't think just the defense stocks. This innovation will happen and will help broaden out the case for international.
So if you had to identify one major assumption that markets are getting wrong about the global economy going into 2026, what would it be?
Well, there's a lot of uncertainty about what does AI mean. Like, does it mean to employees in terms of, is it going to make them more productive? Is it going to lead to job loss? So there's this uncertainty, and it's we don't know. Today, you can't see the path, right? It's not like a well-trodden path. This is exactly what you're going to be able to do with AI, that we're not going to need as many people. But you see it in some of the statistics. They're sort of a characteristic of the jobs market. People are calling no hire, no fire. So you're trying to not add employees, but also you want to keep the employees you have. You want to train them to do things more. But that's also part of that margin expansion story, that you can grow your business without hiring too much more. I think you're trying to see that. Walmart is being used as one of, the Fortune 1 company. I was at an event yesterday, the CEO, Doug McMillon, was talking about how they're trying to use AI to be more efficient, and they're being known as, we're not going to hire more people because we want to keep growing, but we want to use the technology in a very useful way. And I do think you're going to see more examples of that.
How do you expect the interplay between the interest rates, inflation persistence, and global liquidity to shape asset allocation decisions over the next 2 years?
Big story, we got the Fed meeting and talked about lowering rates and then where things go for the future. We do think the Fed is still a little bit too tight. So there's a lot of debate. You've got President Trump who pounds the Fed saying you're too slow. And in a way, we have been agreeing with him on that, is that the US Fed has been very slow in adjusting policy rates. We do think they should be closer to 3, so they probably have another few cuts to get towards 3%. But there's uncertainty, right? So the price level is high. You've got anxiety over the cost of food and other things. And so you've had cumulative price increases that aren't going down.
Yeah.
And so that leads to this anxiety on that. And I think you heard the Trump administration dial back some of the food tariffs because of that issue. But we do think the trend in inflation is coming down in some way. In the official statistics, there's some biases in how they calculate things that we think will lead to a softening over time. But also this AI productivity should lead to an offset of some of the inflation pressures. So there's things that say it's high and there's these other offsets. So I think it's trending down. We think they should get towards what's a neutral rate, close to 3%, and you're seeing still stimulus. So I think the backdrop from a macro perspective is still actually pretty supportive for markets.
So for investors who worry they missed the AI rally, what are the most compelling second and third other opportunities that don't rely on picking the next mega cap winner?
Yeah. Well, it goes back to everybody. It's really everybody outside of the Mag 7. Like if you go to broader baskets, there will be AI beneficiaries. The economy as a whole will benefit. Margins will expand. I think we mentioned WTV, that 12, 13 PE basket. Every company will have the opportunity to learn to use the technology, and there will be winners and losers. Not every company is going to use it right, but everybody will get better. And so I do think it's not just viewed as just a Mag 7 only trade. I mean, that's who's been winning recently, but there will be the rest of the market will be able to utilize this technology as it gets cheaper and it advances and people to see how to do it. And so just investing in the broad markets will give you exposure.
Looking at long horizon strategies, 10 years or beyond, where do you see the most mispriced risk or overlooked sources of real return?
Well, we talked about the US versus international. Like if you look at a global benchmark, it's now 2/3 US, 1/3 international, which is, we think, in some ways over-relying on the US at a little bit of higher multiples, as we talk about. So I think the international opportunity set is still there. I would, if anything, I would be thinking of leaning into international, leaning into some of the smaller companies beyond the concentrated large caps. That is, I think, an asset allocation tilt that we'd favor. I think adding in other diversifiers like commodities, you've seen gold have a major move this year, and there's concerns about the purchasing power, also other inflation risk, debt and deficits. I think commodities have a good diversifying role in portfolios that people are seeing. And I think just being global is that good mindset that we came back to.
And just the last question, which is WisdomTree often emphasize innovation in ETFs. So what new types of exposures or product structures do you think will define the next generation of investment vehicles?
Well, I think one of the challenges has been when you add these diversifiers, when you add gold or when you add commodities, so like what are you selling to do that? Do you want to sell your stocks? Do you want to sell your bonds? We've been pioneering something called capital efficiency and your core. So about 7 years ago, we launched a stock-bond combination in a ratio of 90-60. So for every dollar, we put 90 cents in stocks and 60 cents in bond futures. That family now has a few $1 billion in it, and we started doing it with gold. So you could put every dollar, we put 90 cents in stocks and 90 cents in gold futures. And so whether it's gold miners plus gold futures or stocks plus gold futures, they've been some of the top performing ETFs this year because they aren't sacrificing your core equities to bring in gold. It's sort of layering the two together. And I think you'll see us continue to innovate in that way, providing more capital efficient vehicles to add in alternatives, things that were only available in hedge funds, let's say, that you can now do in ETFs, whether it's long-short strategies or long-short commodity strategies, which we launched. We have something called Inflation Plus, that is long-short commodities plus tips. So very novel, unique things, but are bringing democratization of alternatives to ETFs. And so that's something we're focused on.
Thank you so much for your time. It has been a pleasure to having you in my channel. So thank you again.
Thank you.
Thank you.